Today, as we stand on the date of October 10, 2025, the world of personal finance is undergoing a significant transformation. The Internal Revenue Service, better known as the IRS, has recently enacted a new set of rules governing tax deductions. This is not a minor adjustment. It is a fundamental shift that will touch the financial lives of nearly every American taxpayer. Whether you earn a modest income, consider yourself part of the broad middle class, or fall into the category of high earners, these changes are designed to impact how much of your hard-earned money you ultimately keep. This essay will serve as your clear and simple guide through this new territory. We will break down the complexities, explain what has changed, and provide you with actionable steps to ensure you are not overpaying your taxes. It aims to simplify filing while creating a more equitable system by closing certain loopholes and adjusting deduction limits. Understanding these changes is not just about compliance, it is about empowerment. By the end, you will grasp the essence of the new rule and what it means for your situation, with a clear action plan and checklist for tax season. Before we delve into the specifics of the new IRS rule, it is crucial that we establish a clear and solid understanding of what a tax deduction truly is. Think of your total annual income as a large block of money. The government does not tax this entire block. Instead, it allows you to subtract certain expenses and allowances from it first. These subtractions are called deductions. The smaller block that remains after eligible deductions is your taxable income, the amount used to calculate your tax. Therefore, the more deductions you can legitimately claim, the less tax you will ultimately have to pay. Deductions are designed to provide relief for necessary or socially beneficial costs, mortgage interest, charitable contributions, and certain medical expenses. It is also important to distinguish a deduction from a tax credit. A deduction reduces taxable income, while a credit directly reduces tax owed. For example, a $1,000 deduction might save $220 in the 22% bracket, but a $1,000 credit saves the full $1,000. The new IRS rule primarily focuses on deductions, altering eligibility, amounts, and processes for claiming them. For years, many relied on a consistent set of deductible expenses. Now, the landscape has shifted. The calculations have been recalibrated. A foundational grasp of deductions is your starting point to analyze how these new regulations will shape your decisions in the year ahead. At the heart of the American tax system lies a critical choice, whether to take the standard deduction or to itemize your deductions. The standard deduction is a fixed dollar amount determined by Congress that you subtract from income based on your filing status and certain factors like age or blindness. It is the simplest option, requiring no record-keeping of individual expenses. Itemizing means listing deductible expenses you paid, mortgage interest, state and local taxes, significant medical bills, and donations to qualified charities. If your itemized total exceeds the standard deduction, itemizing generally makes sense. The new IRS rule adjusts thresholds and limits for major itemized deductions. For example, stricter caps on state and local tax deductions, and higher thresholds for when medical expenses become deductible. Practically, many itemized totals are now lower than before. Someone who used to benefit from itemizing may no longer surpass the standard deduction. The rule will push many taxpayers, especially low and middle income, toward the standard deduction. You may still pay a mortgage or donate, yet no longer get a line-by-line benefit. That makes adding up your potential itemized deductions each year more critical than ever. Always compare itemized totals to the standard deduction before you file. For low-income earners, defined here as individuals and families with an adjusted gross income up to approximately $45,000, the new rules largely reinforce a trend towards simplicity. Most already use the standard deduction. Itemizable expenses are typically not high enough to exceed the standard amount. While deductions matter less here, credits become even more important. Credits like the Earned Income Tax Credit and the Child Tax Credit directly reduce tax and can result in a refund. The new rules do not directly alter these credits, but they underscore their importance. Example: A single individual earning $28,000 a year with about $4,000 of potential itemized deductions. With a standard deduction of $14,600, the choice is clear. Standard wins. Energy is better spent confirming eligibility for the EITC. A single missed credit can have a far greater impact than any deduction change. Before you file, use IRS online tools or volunteer programs like VITA or AARP TaxAid to check every available credit. Do not assume you are not eligible. Take the simplified standard deduction and diligently pursue every potential credit to maximize your refund. Taxpayers in the middle income bracket, roughly $45,000 to $150,000 AGI, are most directly impacted. This group has historically existed in the gray area between standard and itemized. Many are homeowners, pay notable state or property taxes, and give to charity. Now comes the itemization squeeze. Higher standard deduction alongside tighter itemized limits. A family once itemizing $29,000 might now see only $26,000 eligible. If the standard is $29,200, itemizing no longer wins. Consider a married couple earning $110,000, $12,000 mortgage interest, $8,500 SALT, and $2,000 charity. Under old rules, they itemized over $22,500. Now they fall short of the standard deduction threshold. They must take the standard deduction. Their specific itemized benefits are neutralized within it. Crucial action. Do not assume last year's approach still applies. Gather mortgage interest, Form 1098, state tax records, and charitable receipts. Use software or a calculator to compare totals. Do the math each year. For high-income earners, typically AGI exceeding $150,000, especially above $400,000, the new rules introduce different challenges. This group almost universally itemizes. Their expenses often far exceed the standard deduction. The issue is not whether to itemize, but how much they can itemize. New regulations place stricter guardrails, more aggressive caps, and expanded phase-outs. Large non-cash charitable contributions now demand stricter substantiation, often third-party appraisals. Theme: increased scrutiny and reduced opportunities for large-scale tax reduction. Example: a business owner earning $700,000 in a high-tax state paying $80,000 in SALT, already capped federally. A $50,000 charitable gift triggers enhanced documentation and verification. Cumulatively, even massive expenses are chipped away, raising the effective tax rate versus prior years. Single most important action: engage in proactive, year-round tax planning with a qualified professional. Plan timing of asset sales. Consider donor-advised funds, structure business expenses, and use tax-advantaged accounts. Ensure large deductions are impeccably documented. For this group, professional guidance is a necessity. Key deduction hotspots: medical, SALT, and charity. Medical expenses are deductible only above a floor. If the floor is 10% of AGI, a family at $80,000 needs more than $8,000 before any deduction. Keep meticulous records, but be realistic about meeting the higher threshold. SALT remains capped, with added integrity checks. Residents of high-tax states feel this most. Small cash gifts need bank records or receipts. Substantial non-cash gifts face more rigorous valuation and reporting standards. For significant donations, coordinate with the charity and a tax advisor at the time of the gift. Your action plan: gather, compare, act. Gather and organize documents year-round. Mortgage interest statements, property tax bills, donation receipts, medical records, and business costs. Perform a preliminary comparison. Add major itemizable expenses and compare to the current standard deduction for your filing status. If itemized is lower, take the standard and prioritize credits. If higher, itemize and follow new documentation rules. If totals are close, use reputable software to run both ways or consult a preparer. Remember, IRS.gov is the source of truth. Before you file, gather all documents, look up your standard deduction, compare totals, check all eligible credits, then sign and submit with confidence.